Back to Market on Close. I'm Marley Caden. It's time for Options Corner here on Market on Close. So we will welcome in Kevin Green, our senior markets correspondent, to see what levels you are watching as we head into the close. Kevin, what are you keeping an eye on?
How you doing, Marley? Yeah, looking at this market today, obviously we saw a considerable amount of pressure on the S&P 500 for the most part all day, but we have seen a little bit of bidding activity taking place here over the last hour or so. And right now we're kind of looking at these levels. At 6,400 level has been an area of one that we expected to be a little bit of an area of support. Unfortunately, we did see that kind of break through, but now it's acting as an area of resistance, and hopefully we're able to actually break above that level and continue to move higher for today's session. But once again, this has been a little bit disjointed when you're looking at the price action to start it off, but we are actually seeing a little bit more orderly action when it comes to the market. If we're going into the close, we do have some pen risk at the 6,400 level. There's over 100,000 contracts traded for those 6,400 calls that are expiring here today. And if you actually look at the technical setup on the intraday chart here, you could actually make the case that we had potentially a little bit of a head and shoulders pattern that took place here. We are pretty much breaking the neckline of that to the upside here, and so that is going to be something key going into the close. Do we have these short sellers that kind of gotten into this market throughout the day start to cover those positions going into the close, knowing that we have some economic and event risk going into tomorrow morning? That would be one thing to be noticeable of. If we do get any type of melt up, I'm looking at 64.30 to the upside as your first area of major resistance after this pen risk. Any move to the downside, 63.70 is going to be your first area of major support here. So overall, this actually is an orderly day. Yes, we did have the markets down about 0.8%, but some bright signs just to kind of highlight here. Liquidity levels have come down since Wednesday of last week, but they're not at anemic levels, and we're not seeing aggressive price action on an intraday basis. I think those are two wins for the bulls for the market for right now, even though we could continue to move to the downside. If it's an orderly sell-off to the downside, I think that's actually better than seeing really aggressive price action on an intraday basis, meaning 5 to 8 points swings in a matter of 30 seconds or even a minute. That's just not what we're seeing right now, and you are seeing some buyers actually stepping into some of those Mag 7 stocks as well, and that's going to be obviously the leaders for us to try to get us back to all-time highs here.
And Kevin, an earlier guest and I were talking about, what we've talked about too previously, the seasonality and September being a weaker month. But as you look at the technicals and you say it's an orderly day, but are we historically behaving within normal patterns, or are there flags that you're seeing in the technicals that would indicate that we are not behaving in a normal seasonal September?
Yeah, well, so there's going to be both. So if you're looking at it from a technical standpoint, if we look at the E-mini S&P 500 chart here, we have this channel that we've been following for the last couple of months. Technically, we have broken down from that channel, at least for now. Maybe we do see a close of another 20 to 30 points to the upside and actually keep that channel intact. That would be ideal. But we are actually still holding some areas of structure. If we're looking at the lows that we had back on June 20th, and we have a volume-weighted average price, basically it just averages out the volume and then also the price action throughout that time frame here. You can see that this is actually a key area of support where we got fairly close to actually touching that line. That's going to be your area of support that I'm kind of focusing on. If we break below the 63.53 area for the E-mini S&P 500 futures, that's going to be your first major break, in my opinion, to the downside that signals that maybe we have more room to run lower here. And so I would say take a stair-step approach, just like we saw this time last week, where we had maybe a little bit of friction in the markets, a little bit of gyration in the markets, but the technicals over the long term actually held up. Now RSI doesn't look that great. Obviously momentum has been losing or waning here, and MACD doesn't look that great, but I'm looking for this channel to stay intact and that moving average to stay intact here before you get too confident as a bear that you could really try to knock this market down.
And as I look at, the sector performance on the day, Kevin, a pretty substantial decline in tech today. We're seeing healthcare up just slightly, energy sort of on the unchanged, but overall a red day. Any sectors in particular that you're watching?
I like to look at the ratio, especially tech versus utility ratio, and I actually have this compared to the VVIX, so vol of vol. So we have seen obviously a spike in volatility if you're just looking at the VIX or if you're looking at the VVIX. But what's interesting about this price relationship here is that last week we actually saw a break of this downtrend line here, and we usually do see obviously utilities outperforming technology anytime we have volatility hitting this market, but it doesn't mean that it has to last for that long. Now, what I mean by that long, could it last for another 4 sessions, 5 sessions? It could, but it's knowing that we have this technical break to the upside for this ratio, just meaning that orange line moving higher just means tech is outperforming utilities and vice versa. I would say, once again, we have a spike in vol, but it doesn't seem like we're going to have vol kind of stay elevated or aggressively re-rate higher without another catalyst, Marley. And that's actually being evident by today. If you're looking at the VIX, last time that I checked, the VIX was sitting at around 18, let's say 18 and a half or so. We actually had a higher realized volatility in the market today for the S&P 500 than we do have priced into the VIX, which is actually a little bit abnormal, just meaning that the VIX should be a little bit higher and it's not. And I think that's probably because of the fact that the market is kind of taking a wait and see approach, and maybe a lot of this fear and uncertainty that we have is already kind of being priced into vol until we have something that really kind of shakes us on the economic front. And I think Friday probably would be that bigger catalyst with the BLS report to do so.
Definitely have some data coming. JOLTS tomorrow, payroll on Friday, some numbers that are those potential catalysts. Kevin, we appreciate you breaking that down for us during Options Corner. You'll be back with us again for our Zscaler earnings a little bit later in the show.